Hello, this is CA Reshma Jain here. Today we are going to start the topic capital gains for CA Intermediate applicable for May 2025. So let's start. Okay, to start with, we'll first take up. Okay, so we'll see what section 45 says. Any profit or gains arising from the transfer of a capital asset will be chargeable as capital gains on the year of transfer. So there should be a transfer, there should be a capital asset and will be taxable as capital gains in the year of transfer took place, in the year in which tax transfer took place. Okay, so now we'll see what is capital asset. What is capital asset? Capital asset is nothing but property of any kind held by SSC, whether or not connected with his business or profession. So it could be mobile or immovable property, whether or not connected to business or profession. So property can be of any kind. And any securities held by foreign institutional investor will also be considered as a capital asset. ULIP is not there for CA intermediate, so we'll skip it. However, it does not include, what capital asset does not include is stock in trade. Stock in trade will be going to our regular P&L, will be taxable under PGPP, so we are not taking it. And next is personal effects. Say personal effects, say any movable property which we are using for our personal use, then such personal effects will not be considered as a capital asset. But there are some exclusions to it, like jewelry, archaeological collection, drawings, paintings, sculptures, any work of art. So these will not come under the capital asset. And rural agricultural land. What is rural agricultural land? Which is not a urban agricultural land. What is not a agricultural land? See, for this we need to understand that urban agricultural land situated in urban area will be urban agricultural land. Suppose now we should see what all land will come under urban agricultural land. Suppose there is a population of 10,000 or more, and in or around 2 kilometers will be considered as urban area. Suppose in a place where there is a population of 1 lakh or more, in or around 2 to 6 kilometers will be considered as urban area, and for population more than 10 lakhs, 6 to 8 kilometers will be considered as urban area. So any land situated here will be treated as urban agricultural land, and land away from this will be treated as rural agricultural land. Okay. Then specified gold bonds. Specified gold bonds issued by CG will not be considered as a capital asset. Special bearer bonds and gold deposit bonds issued under gold monetization scheme will not be considered as a capital asset. So we can see here, capital asset property of any kind held by the SSE, whether or not connected with business and profession, excludes stock in trade, personal effects, rural agricultural land. And any security held by FII will be considered as a capital asset. Gold bonds and gold deposits bonds issued under gold deposit scheme will also be excluded from capital asset. So these are all the exclusions from the personal assets which are used for the business. These are all the personal assets. Though these are the personal assets, these will be regarded as capital assets, though used for personal purposes. Now, what is short-term and long-term capital assets? For determining what is short-term and long-term capital assets, we have to check the period of holding. So now what happened is, there is a date 23rd July 2024. Before, what happens in the case transfer takes place before 23rd July 2024 and after 23rd July 2024. So there is a recent amendment happened. So we'll check what is it. Security other than unit listed in RSC unit of equity oriented fund, and unit of UTI, and zero coupon bond. For such, if the period of holding is up to 12 months, then it's a short term capital asset, and if it is greater than 12 months, it's a long term capital asset. For unlisted shares, land and buildings or both, 24 months will be taken into consideration. For unlisted securities other than shares, your unlisted shares are there, unlisted securities other than shares, your listed security is there. So unlisted security other than share and other capital asset, 36 months will be taken into consideration. Okay. Now what happens after 23rd July 2024? These both are merged and put as 24 months. So for and other than unit is been strike off. Security listed in RSC, unit of equity oriented fund, zero coupon bond, it is 12 months. For other capital assets, it is 24 months. Okay, your mention to a section is given section 50AA, which means that any unit of specified mutual funds, market linked debentures, or unlisted bonds or unlisted debentures which is transferred after 23rd July 2024 will always be short term capital assets, irrespective of the period of holding of such assets. So generally we have to check period of holding to determine whether it is a short term capital asset or long term capital asset, right? But section 50AA provides that specified mutual fund, units of specified mutual fund acquired on or after 1st April 2023, market linked debentures, unlisted bond, unlisted debenture which is transferred, redeemed or matured after 23rd July 2024 will always be treated as short term capital asset irrespective of period of holding. Now here we have seen units of equity oriented mutual fund, right? Now what is equity oriented mutual fund? Equity oriented mutual fund means where sum is invested in equity shares. Suppose I am investing in a fund which is investing in another fund which is investing in equity shares of a company, of a domestic company. Equity shares of a domestic company listed in RSC. So if I am investing in a fund, 90% of it is invested in another fund which further invests 90% of its amount in equity shares. So such is called equity oriented fund. Now in any other case, suppose I am directly investing 65% of my proceeds of such fund in equity shares of domestic company listed in RSC. So if I am directly investing 65%, I should invest. If I am indirectly investing 90%, okay, 90% of such 90% should have been invested. If I am directly investing, minimum of 65% of the proceeds should be invested. Such is called a equity oriented fund. What is zero coupon bond? Zero coupon bond is where I am issuing first at a price of say 85 and then redeeming at say I am issuing at a price of 85 and redeeming at a rate of 100. So here what happens is the difference is the benefit like on received on maturity. So here zero coupon bond is issued by infrastructure capital company or infrastructure capital fund or infrastructure debt fund of a public sector or scheduled bank on or after 1st June 2025 in respect of no payment and benefit is received before maturity or redemption from such issuing entity and which central government may notify. So in this, now will zero coupon bond will be considered as transfer? Yes, when we study transfer we will see that Zero coupon bonds will be considered as transfer, and the chargeability of tax we have rate of tax we have checked here. If it is holded less than 12 months, short term capital asset; if more than 12 months, long term capital asset. Now, before proceeding to determination of period of holding, first let's see what is transfer. What does transfer means? Transfer means, it's an inclusive definition. It means sale, exchange, relinquishment of the asset. It can be sale, exchange, relinquishment of asset, extinguishment of any right, compulsory acquisition under any law. See, what is relinquishment of right? Suppose we have renounced the option of right shares, that is relinquishment of right. So, it could be any sale, exchange, or relinquishment of right. Conversion of capital asset into stock in trade. Conversion of capital asset into stock in trade will also be regarded as a transfer. Redemption of a zero coupon bond will also be regarded as a transfer. Part performance of a contract. In lieu of part performance of a contract, suppose we enjoy possession of an immovable property given in consideration, then such possession will be considered as a transfer, though the registration or agreement is not entered into, but we are still enjoying only the possession, still it will be considered as a transfer. Last, suppose there are any transaction which has the effect of enjoying of immovable property, then that will be regarded as a transfer. Suppose a cooperative society, in a cooperative society there are many members, which helps to, what happens is, so there are many members in the cooperative society. Now what happens is they pay agreed amount to the society, and society allocates flats. So in such a case, this is called enabling the enjoyment of an immovable property. So this will be considered as a transfer. Okay. So let's revise what is a transfer. Sale, exchange, relinquishment of the asset, extinguishment of any right, compulsory acquisition, transfer of capital asset into stock in trade will be considered as a transfer. Maturity or redemption of a zero coupon bond, part performance of a contract which enables the possession of immovable property, or any act which enables enjoyment of immovable property. Such things will be known as transfer. Scope and year of chargeability will be the previous year in which the transfer took place. Now there are certain exemptions to it. Now insurance receipt, suppose we have received insurance in case of flood, like natural calamities, flood, typhoon, hurricane, cyclone, earthquake, or other concussion of nature. So section 45(1)(a) says that if we are receiving any insurance receipts based on such natural calamities or riot or civil disturbance, accidental fire or explosion, or by action of enemy or action taken in combating enemy with or without declaration of war, then such entire proceeds will be considered as consideration, and it will be taxable in the year of receipt. Generally what happens, we are capital gains is charged in the year of transfer, but here in the case it will be chargeable to tax in the year of receipt. What will be the full value of consideration? The fair market value of the money received, or fair market value of the asset received on date of receipt shall be deemed to be the full value of consideration as a result of transfer of such capital asset. So it is very clear, generally capital gains is charged in the year of transfer, but in case of insurance receipts, what happens is it will be treated as transfer in the year when the money or other asset was received, and full value of consideration will be the money which is received plus fair market value of other assets which is received on the date of transfer. Conversion of capital asset to stock in trade. When we are converting capital asset to stock in trade, we will not consider the transfer when we are converting it, but we will consider this transfer as capital gains in the year when we are selling the stock in trade. So what happens when we are selling the stock in trade? Two implications happens. One is the sale value. See, when we are selling when we are converting the capital asset to stock in trade, what happens is FMV on the date of conversion, FMV on the date of conversion minus index cost of acquisition on improvement will be our capital gains. Okay, and the sale price of stock in trade minus FMV of that conversion will be treated as business income. So what happens is till the year of conversion only we are taking it as capital gains. Anything further we are receiving after the conversion will be treated as business income. So both of these will be chargeable when these will be chargeable in the year which stock in trade is sold. See here, now what happens is we have converted a certain capital asset to stock in trade in the financial year 23-24. Okay, the same stock in trade we are selling it in the financial year 24-25. Now FMV on the date of conversion is 5 lakh and index cost of acquisition is 3 lakh. Sale proceeds is 6 lakhs. So how do we do here is sale proceeds 6 lakhs minus FMV on the date of conversion 5 lakhs will be treated as business income, and the FMV on the date of conversion 5 lakh minus index cost of acquisition 3 lakh will be treated as capital gains. Both this will be chargeable under PGBP. This will be chargeable under capital gains based on short term or long term capital gains, and this both will be chargeable to tax in the year of sale of stock in trade, that is financial year 24-25. Now compensation on compulsory acquisition. What happens is whenever government compulsory acquires a capital asset, it gives compensation. So the date of transfer will not be same as date of compensation maybe. So generally such transfer will be chargeable to tax the previous year in which such compensation is received. Okay, we have received the compensation, then we have gone to court that compensation is not enough. The court of law has enhanced our compensation. So what happens to that enhanced compensation? It will be taxable in the year in which such enhanced compensation is received from the government. Cost of acquisition in case of enhanced compensation. So when we are receiving first compensation, we would have done is we would have subtracted the cost of acquisition from the compensation amount, and might have computed capital gains. So cost of acquisition in case of enhanced compensation will be nil because we have already taken the cost of acquisition here. Compensation received in pursuance of interim order deemed as income chargeable to tax in the year of final order. So until final order is passed, any compensation received in interim order will be chargeable to tax only in the year in which final order is being passed for the such compensation. What if there is a death of the transferor? If the death of the transferor, the enhanced compensation will be taxed in the hands who receives the same. What if there is reduction in the enhanced compensation? If there is reduction, then it shall be recomputed by the way of rectification. What will happen? It will be recomputed. The compensation, the capital gains will be recomputed by way of rectification. Now we'll go to capital gains in case of distribution of assets by companies in liquidation. Now, whenever the company is liquidated, it shall distribute its assets, right, to the shareholders. Now, what will happen when it distributes the assets to the shareholder? We will see two cases. What happens in the case in the hands of the company? What happens in the case in the hands of the shareholders? Now, this distribution is not a transfer, will not be considered as a transfer as per section 46(1). Okay, this is not considered as a transfer and no capital gains tax will be coming. What happens in the hands of the shareholders? Now, such distribution of assets attributable to accumulated profits of the company will be deemed as dividend. Matlab, whatever assets we are having which is attributable to the profits, accumulated profits of the company will be deemed dividend and will be chargeable to shareholders as IFOS. And apart from that, money received and FMV of the asset received minus, so whatever money and FM we have received, we have to deduct this deemed dividend. What we'll get is the full value of consideration we have received. This we should consider for computing the capital gains in the hands of the shareholders. Okay, to repeat, whenever there is distribution of assets by companies in the process of liquidation, it is exempt, no, in the hands of the company. Like this, there is this, sorry, not exempt, like this distribution is not considered as a transfer. In the hands of the shareholders, what happens is distribution attributable to the accumulated profits of the company will be considered as deemed dividend, and take the total money and FMV received, subtract the deemed dividend, we will get the full value of consideration for computing the capital gains. Now, what will be the cost of acquisition? Cost of acquisition will be the cost of acquisition of the original shares. Okay. Now let's go to capital gains on buyback of shares on specified securities. Whenever there is a buyback of shares or specified securities, we will see what happens in case other than a domestic company, and in a case of a domestic company. For domestic company also, buyback if affected before 1/10/2024 and if buyback affected after 1/10/2024. So what we'll be seeing in case of shares other than domestic company, buyback happens, or in case of domestic company, if buyback happens before 1/10/2024 or after 1/10/2024. So here in this case, for other than domestic company, it will be as if capital gains will be chargeable in the hands of the shareholder. So any consideration received by the holder of specified securities is chargeable to tax in the holder of the specified securities. The difference between the cost of acquisition and value of consideration received by the holder of securities is chargeable as capital gains in his hands. So when it will be charged when such securities are purchased by the companies. So what happens is, okay, so when buyback happens, if it is other than domestic company, then amount received by the shareholder, it will be taxed in the hand of shareholder, and minus cost of acquisition will be the capital gains. Now, if it is buyback by domestic company, whether listed or unlisted, both, if buyback happens before 1/10/2024, what happens is buyback, the company should pay tax at the rate of 20% tax plus 12% surcharge plus 4% cess. In such a case, it will be exempt in the hands of the shareholder. What happens is buyback is after 1/10/2024, amount received will be charged under the head IFOS in the hands of the shareholder. And what happens to the shareholders? They have cost of acquisition, right, of such shares What will happen to that cost of acquisition? See, receipt will be chargeable as IFOS, so full value of consideration will be nil. Cost of acquisition can be taken as short term capital loss, and the benefit of set off and carry forward of loss will be given. Yeah, see here. So, what happens is any sum paid will be treated as IFOS, and no deduction of expenses would be available for such dividend income. It will be treated as dividend and charged to IFOS, and no deduction of expense, because the cost of acquisition we will be taking as capital loss, and same can be set off and carry forward after. If it is long term capital loss, it will be set off again long term. If it is short term, it will be set off again short term. So it could be any short term or long term capital loss, not only short term capital loss. It can be short term or long term capital loss. Okay. Transactions not regarded as transfer. Transactions not regarded as transfer. So we have seen what is transfer, what is capital asset, and special cases of liquidation and buyback of shares. Now we will see what is not regarded as transfer. So whenever there is total or partial partition of HUF, in such a case when capital assets are transferred, then such is will not be regarded as a transfer. Or any asset if we are receiving as a way of gift or will or by irrevocable trust, then it will not be regarded as a transfer, except in the case of ESOP. And transfer of capital asset by holding to 100% its wholly owned subsidiary, and subsidiary company should be Indian company, then it will not be regarded as a transfer. Capital asset transfer by subsidiary to its 100% holding company being Indian company, it should also subsidiary company should also be Indian company. Your holding company should be Indian company, then it will not be regarded as transfers. Transfer of amalgamating company, capital asset by amalgamating company to amalgamated company in the scheme of amalgamation will not be regarded as transfer. Transfer, you know what is amalgamation, right? When one or more companies merge to form a single company, or two or more companies come together and form a company, is known as amalgamation. What is demerger? When there are two or three undertakings of a company, it demerges a unit into a separate company, is known as demerger. In such a case, there will be transfer of property, right? Such transfer will not be will not be regarded as a transfer. Transfer of issue of shares by the resulting company in scheme of demerger. So what happens here in the case of amalgamation? Old shareholders will be given the share of the new company. So such transfer of shares will also not be regarded as transfer, and here also the the resulting company will be allotted shares of the new company. The shareholders of the demerged company will be allotted the new shares of the resulting company, will not be treated as a transfer. So you can see a transfer of issue of shares by resulting company in the scheme of demerger. So this is resulting company, this is demerged company. Transfer of shares from resulting company to the demerged shareholders of demerged company will not be regarded as transfer. And transfer of shares by shareholders in scheme of amalgamation will also be not regarded as a transfer. Now, transfer of government security outside India by NR to another NR will not be regarded as transfer. So there is an NR, one more NR, and transfers government security. It will not be regarded as transfer. Redemption of sovereign gold bonds, conversion of gold into electronic gold receipt or vice versa, Transfer of specified capital asset to the government or university, like work of art. If we are transferring capital asset to government or university, like work of art, archaeological, scientific art collection, book, manuscript, drawing, painting, photograph, print, all this will not be regarded as transfer. Transfer of conversion of bonds or debentures into shares or debentures, not regarded as transfer. Conversion of preference shares into equity shares, preference to equity, will not be regarded as transfer. Transfer of capital asset under reverse mortgage scheme. What is reverse mortgage scheme? It is a scheme for the benefit of the senior citizen, in which suppose there is a senior citizen who wants some money to your and has a house, who wants maybe a monthly flow of money. So what he does is he gives the house property to the bank. Bank pays fixed payments to the senior citizens. In such a case, on the death or the expiry of the term, if such house property is transferred, then such will not be regarded as a transfer under reverse mortgage for the purpose of capital asset, capital gains. Okay, we have seen that any transfer of capital asset and any transfer of shares in case of amalgamation and demerger will not be regarded as transfer. Now, what is amalgamation and what is demerger? Amalgamation is when one or more companies merges with another company or two or more companies to form a new company. So what are the rules for amalgamation? All the property of the amalgamating company immediately before the amalgamation should become the property of amalgamated company. All the liabilities of the amalgamating company immediately before amalgamation should become the liabilities of the amalgamated company. Shareholders not less than 3/4 in value of shares of the amalgamating company should become the shareholders of the amalgamated company. Shareholders by virtue of amalgamation. So if these conditions are satisfied, then this is called amalgamation. Now what is demerger? Demerger means all the property of the undertaking. Suppose there will be two undertaking 1, undertaking 2. Undertaking 2 is demerged and separate companies formed as U2. So all the properties of this U2 should be transferred to this. All the liabilities of this should also be transferred to this. And 3/4 of value of shares of the demerged company should become the shareholder of the resulting company. 3/4 of value. Remember, 3/4 of value of shares. Demerger should be going concern. On the basis of going concern, it should have been taken place, and it should be according with the central government norms. If such conditions are satisfied, then any transfer of property or shares will not be considered as a transfer. What is demerged company? This is demerged company. This is demerged company and this is the resulting company. Mode of computation of capital gains. So when we are computing capital gains, what happens is, from the cost of acquisition, many times in the cost of acquisition we would have added or capitalized the borrowing cost, right? Interest. If we have capital, and suppose while applying accounting standards, we have capitalized interest on loan to the cost of the capital asset. So our cost of acquisition includes the interest, and that interest we have claimed under section 24B as well. So will we get the benefit of using this amount in the cost of acquisition? No. And suppose while while purchasing asset, we would have paid stamp duty charges or ATEE deductions would have been taken under Chapter 6A. So once the deductions are taken, will we be allowed to take again the benefit in the cost of acquisition? No. So cost of acquisition will not include deductions claimed under Section 24B and deductions under Chapter 6A. Any STT paid will also, no deduction will be taken on the STT paid. Okay, while computing capital gains, while before 23 July 2024, only we have the benefit of index cost of acquisition. Indexed cost of acquisition after 23rd July 2024, we are not getting the benefit of index cost of acquisition. This was the amendment. So what happens is, any transfer taking place before 23rd July 2024, we will get the benefit of cost inflation index. What happens is, we have to multiply cost inflation index in the year of transfer plus cost inflation index in the year of first held by the SSC, asset first held by the SSC. So cost of acquisition is indexed. This is only applicable before 23rd July 2024. That too, it index cost of acquisition, we are not getting the benefit for all assets. Let's check. For assets, we are not getting the benefit. For bonds and debentures, no indexation benefit will be given, even if it is before 23rd July. Capital indexed bonds. So these are also bonds, but capital index bond issued by government, we will get the benefit of indexation. Sovereign gold bonds will get the benefit of indexation. Depreciable assets, we are not getting benefit of indexation because depreciable assets are always considered as short term capital assets. Units of specified mutual fund acquired on or after 1/4/2023 and market linked debentures as per 50AA. These two assets will always be considered as short term capital assets despite of period of holding. Equity share on which STT is paid, unit of equity oriented fund, capital inflation indexation benefit will not be given. For other long term capital assets, we can use the indexation benefit. After the amendment, what happens? There is no benefit of indexation on any capital asset on transfer taking place after 23rd July 2024. Now here what happens? Suppose I have a land and building. I have purchased it before 23rd July 2024 and transferred it after 23rd July 2024. See, if I'm a resident individual, an HUF, okay, I have purchased this, acquired before 23rd July 2024 and transferred it after 23rd July 2024. Will I be able to get the benefit of long term capital gains, index cost of acquisition? So there are option for such resident individual and HUF that it can either pay tax at the rate of 12.5% without indexation benefit or 20% with indexation benefit. What happens if it is transferred after 23rd July 2024? It doesn't have any option. It has to pay the capital gain without indexation only at the rate of 12.5%. Okay. So let me repeat, what happens if it is purchased before 23rd July 2024 and sold after 23rd July 2024. It will get an option to pay tax at the rate of 12.5% without indexation benefit or 20% with indexation benefit. So this benefit is only given for computing tax. While computing tax only, we should take indexation and compute tax. In while computing gross total income, no, when we are computing gross total income, then such indexation should not come. Only cost of acquisition should be subtracted and gross total income, the value should be given. Only for computation of income, computation of tax, such benefit is given. Not while computing income under the head capital gains, which would form part of gross total income. Thus, for computing income under capital gains to be included in gross total indexation benefits not given in case of resident individual HUF. Okay, I think I'm clear. Okay, suppose I am given an ESOP. I am transferring such ESOP and as a gift, and I am receiving consideration. Am I receiving consideration? No, I am giving as a gift. I am not receiving any consideration. Okay, I am giving as a gift. So what will happen in such case? Special provision for non-residents. What happens? Non-residents who acquire capital assets and as a result they get capital gains. What happens? Will they get benefit of currency fluctuations or not? See, what happens is they have cost of acquisition. There will be some expenditure incurred in such a transfer, and there will be full value of consideration. So all these things are converted into same foreign currency with which such shares are acquired. He would have acquired such shares in some currency. So all the cost of acquisition, expenditure incurred in the transfer, and full value of consideration will be converted into that foreign currency in which he has acquired. And what rate? Telegraphic transfer buying rate, average of telegraphic transfer buying rate and selling rate on the respective dates, respectively on the cost of acquisition date, sale date, and the expenditure incurred date. TTBR plus TTSR divided by 2 will be the rate, and it will be converted based on such rate. The resulting capital gain, after converting we will get the capital gain. It will be again converted to TTBI on the date of transfer. This is to why this is given? To prevent them from the risk of currency fluctuation. In this case, will indexation benefit given? No, benefit of indexation will not be given in such a case. Okay. Now, there is a point given here on long-term capital gains arising on transfer of unlisted securities or company in which public are substantially interested. In such a case, non-residents and foreign companies are taxed at a concessional rate of 10% without indexation or currency conversion benefit. If such transfer takes place before 23rd July 2024 and 12.5% without indexation or currency conversion benefit, such transfer takes place after 23rd July 2024. The benefit of currency would not be applicable to the long-term capital gains arising from the following assets: equity share on which STT is paid, equity oriented unit of equity oriented fund or unit of business trust on which STT is paid. So on such transfers, benefit of currency conversion will not be given on which STT is paid. That is governed under section 112A. And here what it says is, when there is a non-corporate, non-resident and a foreign company, non-resident and a foreign company, and they are dealing in the unlisted securities or shares of a company which public are not interested, and they are getting long term capital gains. So there is foreign company or non-resident having long term capital gains resulting from a transfer of unlisted securities, then they have option of if such transfer takes place before 23rd July 24, and if such transfer takes place after 23rd July 2024, then the rate will be 10% here, it will be 12.5% here, without indexation benefit and without the benefit of currency conversion. Such income will be taxable. The same is mentioned here. If the transfer takes place before 23rd July 2024, non-corporate, non-resident and foreign company dealing in unlisted securities or shares of a closely held company, 10% without the benefit of indexation or foreign currency fluctuation. If the transfer takes place after 23rd July 2024 and it deals in unlisted securities, here it comes under other assets, unlisted securities or shares of a closely held company, then 12.5% without indexation and foreign currency fluctuation. So we'll cover this rate of tax as we have come here. What 111A says, whenever there is a short-term capital gain arising on transfer of listed equity share, units of equity oriented fund, units of business trust, an STT should have been paid on such sale. If such transfer is before 23rd July 2024, it is 15%. After 23rd July 2024, it is 20%. So this is the rate of tax for listed equity shares, units of equity oriented fund and unit of business trust. For this period of holding is how much? 12 months, right? Okay. Short-term capital gain arising from transaction undertaking in foreign currency on RSC located in IFSC. Suppose there is transaction taken place in IFSC, and in IFSC there is no need to pay STT. Still, will they get the benefit of 15-20%? Yes, because STT is not required to be paid there. So this benefit of 15-20% only come if the STT should have been paid on such sale. On short-term capital gain or other capital assets will be taken as normal rates of tax. For equity shares, units of equity oriented fund and unit of business trust, it is 15% before 23rd July 2024. If transfer is after 23rd July 2024, it is 20%. For other short-term capital assets, it is taxed at normal rate of tax. Now we'll see long-term capital gains. Long-term capital gains is exempt up to 1,25,000 if listed equity shares STT is paid on such acquisition and sale, and units of equity oriented fund and units of business trust if STT is paid on such sale. So the exemption will in a total previous year will be given as 1,25,000. Now what will be the rate? 10% if transfer took place before 23rd July 2024, or 12.5% if the transfer took place after 23rd July 2024. See, 12.5% is after 23rd July 2024, right? Here also after 23rd July, before 23rd July 2024, it is 10%. After 23rd July 2024, it is 12.5%. So 12.5% is if the transfer is taking place after 23rd July 2024 of listed equity share, equity oriented fund or units of business trust on which STT is paid. Now your STT is paid. Will they be able to get the benefit of currency conversion? No. If such transaction is done in IFSC, will they get benefit of this 10% and 12%? Yes. Benefit of indexation and currency fluctuation will not be available because your STT is paid. So benefit of indexation and benefit of currency fluctuation will not be given here. Now while calculating this, in case of resident individual or HUF, the long-term capital gain or short-term capital gain will be reduced by unexhausted basic exemption limit. So for residential individual and HUF, we can get the unexhausted basic exemption limit. We can use that and we can subtract it from our long-term capital gain and short-term capital gain. Okay, no deduction of chapter 6A will be available in respect of both long-term capital gain and short-term capital gain. Rebate under section 87A is not available for long-term capital gain. Okay, now here again see we have read in 50AA that unlisted, sorry, not 50AA, in respect of bonds and debentures, whether listed or unlisted, transferred before 23rd July, the resultant capital will be considered either long term or short term based on the holding period. So bonds and debentures, if they are transferred before 23rd July 2024, so in that case what will happen, whether listed or unlisted? See, we will see the normal holding period kitna hai, what is the holding period, and will tax accordingly. Now if after 23rd July 2024 unlisted bonds and debentures are transferred, then it will always be treated as short term capital asset regardless of holding period. And indexation benefit, will it be available for bond and debentures if it is transferred before 23rd July 2024 also? No, indexation benefit in any case will not be given. See, bonds and debentures, here no indexation benefit is given. Only capital index bonds and sovereign bonds, we have the benefit of indexation even if it is transferred before 23rd July 2024. So coming to the same point. Okay, so your bonds, debentures before 23rd July 2024 based on the period of holding, we'll see short term or long term capital gains, but indexation benefit is not available in any case. But after 23rd July 2024, unlisted bonds and debentures will always be short term capital gains or loss, will be treated as short term capital assets. Okay, so we have seen this, right? period of holding 12 months, 24 months, 36 months, and after 23rd July it is these both are clubbed to 24 months. Okay, now we'll go to the topic ascertainment of cost in specified circumstances. Now what happens is, here in case of 491, these are not regarded as transfer, right? Capital asset became on distribution of partial partition of HUF. We have seen, right? Asset not regarded as transfer under a gift, will, or by an irrevocable trust, succession or inheritance or devolution, distribution of asset under liquidation of a company, transfer of asset by holding to wholly owned subsidiary and subsidiary to wholly owned company, transfer by way of amalgamating to amalgamated company, transfer by way of demerge to demerge resulting company, conversion by individual to separate property into HF property. So in all these case, what happens is, it is not regarded as a transfer, but what will be cost of acquisition taken? Cost of acquisition, we have not acquired it in any cost. Will we take the cost of acquisition as nil? No. The cost of acquisition will be taken as cost for which previous owner of the property acquired it. Cost for the previous owner will be the cost of acquisition. And for the cost of improvement, if the cost of improvement is before 1/4/2001, ignore it. If the cost of improvement is before 1/4/2001, ignore it. If it is after 1/4/2001, then cost of acquisition or improvement to the previous owner will be added, will be taken as cost of improvement. Period of holding, what will be the period of holding? Whether the period held by us will be taken or period held by the original owner will also be taken. The period held by the original owner, held by the transferee, the period of holding of the asset by the previous owner shall also be considered. So in such a case, period of holding, we should include what is the period of holding the previous owner has taken, what is the cost to the previous owner while calculating cost. Now benefit of indexation will, when will the benefit of indexation will come? Benefit of indexation will come first in the year previous owner first held the asset, in the year in which previous owner first held the asset. So indexation will come from that year. Okay. Now in case of amalgamation, what will be the cost of acquisition? The cost of acquisition shall be taken as cost of acquisition shares of the amalgamatic company. In case of amalgamatic company, what was the cost of acquisition? That cost will be taken. In case of bonds, when a person becomes owner of shares or debentures in a company during the process of conversion of bond. Okay, whenever there is conversion of bonds, what will be the cost of acquisition? The cost of acquisition will be acquired by the, how much of cost it has taken to acquire, how much cost it took to acquire by that person will be taken into cost of acquisition. Now where the capital gain arises from transfer of specified security or sweat equity shares. In case of sweat equity shares, fair market value which has been taken into account for perquisite valuation will be taken as the cost of acquisition.